That's all right. So, hey,
I know.
let's flip gears a little bit and really talk about what we're seeing, right? We've been in this now, I don't know, let's call it 10 weeks. And I think it's time where the experienced folks can start to see a bifurcation of what's going on. And for me, rightly or wrongly, I'm starting to see pretty big divide between what's going on with what I'll call the owner occupant or residential market, and then what I see stress and pain going in the commercial market. And I'll turn it over to you in a sec, but just
Mhm.
to start here, I think the residential side, meaning, single family homes, unemployment, consumers, right? That set of folks, which I play in a lot. Right now, it's kind of an artificial world, right? We have enhanced unemployment. We have forbearance, which is taking care of the expense side of the income statement for lots of folks if you need it. And it's kind of, it really is a pause button for most folks, right? They're buying time. But then I go over and look at the commercial sector, which again, I have not looked at any great detail for the last 20 years, but I have been looking at it the last 10 weeks. And what I see is I see a champagne bottle where the pressure is building. And I think that side's going to pop first, right? The REITs, office buildings, threats of, not only vacancies, but the strong tenants want lower rates. And it's just, I guess I'm most nervous about the commercial side. And I wanted to come to a guy like you who plays there. Am I just a naive newcomer who doesn't get it? Or what do you see on those two sides?
Yeah, no, I mean, you're absolutely right. It's really interesting when you go back to 2009 and 10, it was the housing market that died and that tanked. And that commercial market was on the precipice, but the banks didn't let that shoe drop. That was a
Right.
big one that was in trouble, in distress, and had issues, but the banks did not let that one fail. So
Yep.
they kind of worked that one through, propped that up. I mean, there was a little bit like, from a developer standpoint, there were, subdivision loans that were getting
Yeah.
called due, things like that. The housing market in most areas of the country that were healthy and strong before this are still healthy and strong. There's less inventory overall, as we know. People have pulled
Yeah.
their houses off the market, so it's making it even tougher. The interesting thing that's going to happen in the residential housing market to watch is two things. One, as you know, cities. So there's a lot of the work at home thing.
Yeah.
So like all of the, Silicon Valley companies are allowing people to move,
Yep.
leave the city. Some people are doing that, work from home. We're seeing that in New York. You're going to see it in LA. So you're going to have a little bit. I don't know it's going to be enough to make a dent. These are great, iconic cities that have always withstood any disaster. This is different. So there'll be a little bit of flux there. So I don't know what the real effect on the housing market's going to be there. You'll just have to see. Short-term rentals. So short-term rentals, specifically vacation rentals, as we know, has been obliterated, during all this, because most of them were just completely shut down. That's the market that I started in the business in. I was in a resort vacation market, short-term rentals. So that's what I was doing, building and selling those, buying and renovating them. So I owned at any given time, 10 to 15, sometimes $20 million worth of these things that I was building and selling, multi-million-dollar, vacation rental homes. That's what I did. And, in the early part of my career before I got into commercial and multifamily. So that market, especially where I came from, it'll be really interesting to see how does that look moving forward. And the beaches all just reopened this week down there for visitors and Memorial Weekend. So I'm real curious to catch up with some people and see what the occupancies look like, what the traffic look like, and what the summer is going to look like, and then, how all this goes. So those are the things to watch in residential. Big city exodus, vacation rental markets, how does that work through, and where are the opportunities there? I think, that may be a little bit of distress there. Flip to the commercial side, huge distress, huge distress. And what the Fed has done and is doing is propping up the banks and the funds that are holding that paper. Okay. But ultimately, those assets they're going to get let go. So if it's a REIT that owns them, if it's a fund that owns them, if it's an investor that owns them, let's just take a huge shopping mall. And now all of a sudden you've lost, 70% of your tenants or some of your anchor tenants. That's going to trigger co-tenancy clauses in your lease that say, as a retailer, let's say you have the Gap store, there's a co-tenancy clause that says if you lose an anchor or a certain percentage of your tenant center goes dark, that's getting triggered all over the place and all over the country. And these malls are just basically trying to figure out, man, what do we do? Now, again, this is all hyper local. Some markets and some malls are very healthy still and back to them. Other areas, I made a video of my local mall the other day that's been, the mall in our area. That thing's dying before this all happened. Now it's just a ghost town.
Wow.
So, there's a lot of these retail and office assets out there that now are vacant and are not going to come back to life. Company after company is going bankrupt right now, between JCPenney and all of Forever
Yeah.
21, The Gap, all these companies that started before this. Now it's more and more and more. So there's a big shoe that is yet to drop in that commercial market that could be a big problem for the banks this time around.
Yeah, and that's where this all leads to me. Again, my experience through the last crash is again, as a resident, the thing that became very common for the individual owner of a house was ultimately something called a strategic default, right? That became the buzzword, right?
Yeah.
Once you got over the stigma, which was like the first 6 or 9 months of losing your house or doing a short sale, which there was a little of that, but once the dominoes got to like month 8 or 9 and everybody was doing it, people were bragging about strategic defaults. And then ultimately where that became a problem is the banks suffered, right? They had so much inventory. I mean, I did a video on a property that I ended up buying for 40 grand that last sold for 200, right? And it just had price drop after price drop after price drop after price drop. So now if I fast forward to commercial, what I've been reading about is I see the same pain, not the same volume, right? Because there's just more residential stuff, but the dollar amounts are freaking amazing, right? There was one fund talking about $1 billion in special servicing already, which means they've already defaulted. But $1 billion is like 43 properties. I'm like, I can't even fathom how big these things are going to be.
Oh, it's hundreds of billions. And so here's what's going to happen. And here's what happened last time. So in the housing market, these, just so people understand, securities were created with bad mortgages, toxic mortgages that were cut up and sold as securities on Wall Street. So the big banks that created these derivatives that took, 10 houses in 10 different cities and carved them up into 10 different pieces and packaged those together as a security, a stock, and then sold it, on Wall Street, on the stock market. That's kind of what the mortgage-backed security market was like in the residential sector. Okay. Yeah. So what was happening was they were taking these loans that were, gosh, what's the term I'm trying to think of, people that couldn't qualify for a loan,
subprime.
So subprime loans, that was a big part of that market. That was people that didn't have the down payment, couldn't qualify for a loan, that were getting put into the market I was in. I was building multi-million-dollar houses. I shouldn't have been able to have 20 of those, right? So I mean, that's what was going on. So those were getting carved up into pieces, sold off as security. So what happened was when that thing went default and defunct and that whole thing started exploding, okay, everything got written down, mark to market. In other words, as an owner, let's say you have 10 properties, you're carrying those properties on your balance sheet as net worth of being worth X according to today's market value. So as soon as the market shifted, all those banks were still carrying those assets on their books at pre-2009 market value. So what happened was they were forced to mark to market, reduce those things down. Now they became worthless. They were negative overnight. Yeah. So here's the kicker. And this is what's going on behind the scenes right now that you're not hearing about, but you will. So the same banks that created these derivatives, Blackstone, Goldman Sachs, Lehman Brothers, these big banks, okay, Bank of America, were creating these derivatives. They're also rating these things. Yeah. They're a rating agency. It's kind of like you as an investor owning the appraisal company that appraises your properties and then owning the bank that finances them. That's what was going on. So these companies that created these derivatives sold them as AAA rated when they knew they were junk, cashed in on that. Then they, in turn, when all these foreclosures happened and the banks were writing down these assets, turned around and bought them back for pennies on the dollar, and now they rent them out and they own them and they're renting them out as rental property. So they have these huge portfolios they picked up for pennies on the dollar. Same thing's going to happen in commercial because these, now they got paid too. So the banks got made whole on all those assets that got written down. The government came in, gave them all this money, written down. They got made whole by the government. Then they ended up buying them back for pennies on the dollar. And now, they have all these properties. So commercial is the same kind of thing. You've got all these assets that are going into default, and there's all this bad paper out there. So what's going to happen, and what's happening, is the government's going to come in. They're going to loan money to these banks to make them whole on the losses. And then these big funds are going to come back in and buy these things up, these toxic assets for pennies on the dollar, and they're going to work through them. So I think that's kind of what you're going to see going on behind the scenes with a lot of these things. So it's really interesting.
Yeah. And then, so when I look at, again, right, I'm the naive person here, or the rookie on the commercial side. First thing I think about is, okay, how can I participate, right? Is there going to be any opportunities for me to buy assets at a reduced price? And honestly, I think these numbers are so big that, you know, my checkbook's not deep enough. So that's the first thing I think about. I go, okay, great, missed that opportunity. And then I think about, okay, what's the ripple effect up into the bank? Because residential and commercial ultimately ends up in the same financial institution. Is there going to be enough pain on the commercial side that ultimately impacts the bank, which means the bank has to raise fees or raise interest rates or risk premiums or whatever, that ultimately impacts my residential side?
Yeah.
And I think my answer is yes, which means my interest rates are going to go up, my fees are going to go up. And then again, all of that impacts the value of the residential side. I don't know. Do you see the same daisy chain or no?
Yeah, so it depends on the bank and what they're holding and their ability to get rid of that paper. So the first thing they're going to try to do is sell that paper. Okay, so if they have commercial assets that are in distress and their residential side is doing well, you know, they can loan based on their deposits, and they can loan based on their balance sheet. So if they're forced to market as things change, if they have properties in distress that are losing value, they're going to have to write that down. And when they do, that's going to create a problem. So the first thing they try to do is get rid of that paper. So that's already happening with local banks. So I've got people I'm working with. You know, I work with people all over the country, and I've got, you know, one of my clients right now I'm working with, that got a call last week about a medical office building that was in distress, and the owner was about ready to go into foreclosure. The bank called him and said, "Hey man, you want to buy this?" So with your local and regional banks, where the opportunities are for the average players and the smaller players, are at the local and regional level, like you're talking about, the special assets manager. That's at your local and regional banks. That's who's handling stuff that's going into default, forbearance, modifications, you know, things like that. So loan forbearance says, hey, you don't have to make your payments. And then at a point, they all come due. And then if you can't, then there's what's called modification. So, you know, those special assets people are the ones that take over those situations. Then you have your REO department, real estate owned. That's properties that have gone through the foreclosure process that the bank now owns and they have on their books. So those are the two departments you want to stay in touch with. And you just want to let them know, hey, you know, I'm liquid, I'm ready to go. Let me know if you need some loans taken over. I'm happy to step in and take them over. Let me know if you have some stuff that you're ready to just peel off your books, and, you know, I can come in and cash them out. So those are your two opportunities. With your special assets, you'll have an opportunity to come in and take those loans over. The bank will finance you, maybe give you a year or two to work through it and get it refinanced, but you can just walk right into them with no money out of your pocket on certain assets. Then you have the foreclosures that you can walk in, that the bank owns. Those, depending on what they are, commercial and stuff like that, they're going to be writing those down. Residential, they didn't do that so much because the residential market's hot, and they're going to try to get as much money as they can, which they have to. You know, they are, subject to the regulators. So the federal regulators, you know, they're like, look, you can't just dump stuff. You got to get at least market value, appraised value for these things, or close to it, or they have to be listed at appraised value, market value first before they can dump them for whatever. So there's a process they have to go through. But when they're distressed, before they reach that position, they have more flexibility. So special assets is a great place for somebody like you and people that may be listing, you know, that can't play in the big arena, and, you know, with these huge assets, which you don't want to anyways. I mean, you know, the big malls and things like that, you know, that's a different conversation, and it'll be interesting to see where those things go. But there's a lot of REITs may not make it through this cycle. There's a lot of investment funds that are, you know, owning those assets that may not make it. And there's a lot of, you know, private owners as well that are going to be in some serious trouble. So it'll be interesting to see how those go.
Yeah. What is happening in some of the section of the REIT market is, I mean, I've never seen anything like it, right? When I had a 401k, which I haven't since I quit working, my entire 401k was in REIT stocks. I'm glad I got out what I did, because there are a lot of REITs trading at 70% drops. And some of them, I'm afraid, I think some REITs are going to go to zero. I just don't know how they survive, given their assets that they bought and financed are not worth nearly what they paid for.
Yeah, they'll have to unwind, liquidate, and close the fund. You So I think we're going to see that in some retail REITs, some of the shopping mall REITs. Now, most of them own some things, but there are some that are just straight up retail.
Yeah.
And they're going to have a difficult time surviving. So it'll be interesting times to watch those.
Yeah, I think there's a whole bunch of, if your REIT is focused, which used to be seen as a good thing, now is a bad thing. If you are focused on assets that rely on crowds, right?
Yeah.
Retail, office. There's a couple of REITs out there that are focused on I don't know what to call them, sports venues or concert venues, right? The big, $20,000
arenas,
arenas.
event
Thank you.
spaces.
I'm like, can you imagine a worse? I'm not sure I can imagine a worse asset today, right? The Chase Center, where I watch the Warriors play, it's been vacant and will likely be vacant for probably almost a calendar year. I mean, God, they just built that for $1 billion.
Here's the thing about all that. And again, the Fed is stepping up the way they're stepping up for a reason, and they're buying anything. I mean, now's the time to do, whatever, because the Fed's just, man, they're buying whatever,
Yeah, that's right. Bring it on.
They might become the biggest REIT in the world, through all this. And that, you might see them buying up real estate. That's the other side of that play. If they can't get Wall Street to play ball, which in the commercial market of retail and office, I'm not so sure there's going to be a lot of people stepping up for a lot of those assets. The government may very well step in and just buy these properties and have a special thing that they've created to own real assets like this, or at least the paper on them until something else can be done. So it'll be interesting to see what really transpires there. But
yeah, and real quick on that, isn't that similar to what they did during the savings and loans crisis? Not to just totally change gears, but the government,
they took over the banks. Yeah.
Right. Which ultimately meant, at least for a little while, I think it was in the 70s or the 80s, the S&L crisis, the bank had a special, I don't know what they called it, a special asset division or whatever it was, where they were the physical owner and operator of lots of real estate, right? So this wouldn't be the first time.
Yeah, it was a nightmare. They wiped out the banks, so that destroyed our system as we know it back then. So that was before my time. I wasn't even, I was middle school, when that was going down.
Yeah.
But it's interesting times. So, again, how do you position yourself? So there's two things going on here. There's one that, there's going to be a short sale market. So a lot of people that didn't participate in 2009 on, maybe don't quite understand short sales. And we learned a lot from that time about short sales and how to do that. So there'll be some short sale opportunities, residential and commercial, which that's kind of where on the commercial side, local and regional banks have the flexibility to be able to do different deals on a short sale versus like the residential mortgage market, right? So that's a more traditional process that has to take place. And for a short sale to take place, what that means is you're selling the property for less than what's owed on it. That's what a short sale is. So there's two people that have to agree. Number one, it's the owner. So even though you're in default or whatever, you still have control of that property as the owner, title holder. So the rules are property has to be on market at appraised value for a certain period of time, generally, before they can, before the bank will accept a short sale offer. So if you've been on the market, whatever that time frame is, and you want to talk to your bank, find out what's going on there at the appraised value, and you start getting offers, it's up to the owner to accept that offer, send it to the bank, and the bank looks at it, decides whether or not they're going to agree on that contract, and then it starts going into the closing process. And then when that short sale is done, if it sells for less than what's owed, they look at that creates a deficiency. Then the bank decides, do we go after the borrower? Do we forgive that? And if it's forgiven, that can be a taxable event. Now, back in 2009 and 10, they wiped that off the books where they, said if people were insolvent at the time, they got rid of that. I think right now they're going to also, I think they're not waiving deficiency, taxation as well. So, that's a good thing. So, that's kind of how a short sale works in a quick nutshell, but they can be very good, but they take time. They're usually very slow, a lot of paperwork, and there's a specific process, and every lender's different. They created these platforms. We had to upload documents. And sometimes you had to do it 4 and 5 times. It was just crazy.
Yeah. Yeah. The other thing that I think is important for folks to remember, and again, we've been in this thing 10 weeks. It's far faster and deeper than anything either of us have ever been through. But the short sale and REO crisis, it unwound, again, very residential focused for 2 to 4 to 5 years, right? There were some states like New York and Florida, I think, who were judicial states, who still had bad debt from the '08 crisis on their books in 2020, right? It's a long process.
Shadow inventory. So a lot of banks, they didn't want to flood the market and really tank the real estate market. So, banks aren't stupid. So a lot of people think, oh man, these foreclosures, I'm going to get the steal of a lifetime. Banks aren't the dumb guys, right? So they were holding off on that shadow inventory and releasing it slowly. And then same thing happened with a lot of these, investment funds. I think it was Blackstone,
Hmm.
is one of the big buyers that came in and just bought, billions and hundreds of billions of dollars worth of these toxic assets
Yep.
you know, um, off of the banks
Hmm.
that had them. And then they turned around and did the same thing. Some they kept and they rented out. Some they just released slowly and sold, and and they made their money. And that's when that whole model shifted to where some of these funds now are owning these houses, because we have shifted to a rental society in a lot of ways. So there's whole subdivisions that are just rental subdivisions that are being developed and that were bought out and things like that. So
Yeah.
it's really, really interesting times. And we still just don't even know. I mean, we're starting to open up now. This is the first big week where pretty much the whole country's open. Everybody's back out there. So over the next 2 to 3 weeks, depending on what the results are of all this, will give us a really good indication of what the future looks like. So hopefully we won't see a resurgence. We won't see this huge, wave, hit us again, and we'll be able to get through this thing and continue on the path of reopening. But I think we've seen, and what we're seeing is the general public still is not comfortable getting out there in mass like they were before, which is kind of what you and I have been talking about all along. When this first started, we were talking about from day one, 12 to 18 months before we recover.
Mm.
Now, I think you can say it's 18 to 24 months before
Oh,
you see any kind of a,
yeah, for sure.
80%, GDP where we were before all this started.
Oh,
And,
yeah.
people are, a lot of people are concerned.
Yeah, the consumer psychology has changed. This was always my question. Is this going to be the event of my lifetime that changes consumer psychology? And I think it is. It's still early to tell, right? We're 10 weeks in. Who knows? Tomorrow we get an announcement that there's a vaccine and the world's, everything's good all of a sudden. But I think this is going to go on longer than we want. It's going to be a slower road back. We're going to have double-digit unemployment. We also are going to have, I just noted this morning, people are savings more, right? And again, when like in Europe, that was the first number I found. An average month in the 5 biggest banks in Europe, people would save $3.8 billion. What they saved in March, 20 billion,
Wow.
5x, right? If we do that in the US, our economy is not going to grow, right? When we take that
Well,
much currency out of the economy,
mhm.
it's going to slow down for sure. It will not come back fast.
Well, we talked about that. I mean, you're going to have that cabin fever spending. You're going to have that revenge spending where people are going to be like, I've been cooped up, I'm going to get out. And then they're going to pull back because, a lot of people have gone through their reserves, have gone through their savings, and they need to rebuild that.
Yeah.
So, especially now when they know anything can and will happen at any time at the drop of a hat. So, and again, that's only about 30% of the workforce. So it's not everybody, it's only about 30 to 40%. And unfortunately it is, as we've seen, it's the retail worker and the hospitality worker. And, those types of industries, it didn't affect at large scale, construction and essential services and things like that. It's a very, small portion of the population, but a big portion of the economy, which is interesting,
Yeah.
that was affected. And even the shopping, I was talking to my wife this morning, just about habits in general. She's like, everybody's laying around in their pajamas, there's nothing to shop for, it's like women. She's like, normally women are out shopping right now, getting ready for the summer and reopen, you know what I mean?
Yeah.
New outfits, new bathing suits. Nobody's doing that, because they're like, we're not going anywhere. I'm laying around the house, so what's to shop for?
Yeah.
Let's just wait till the fall.
Yeah. Pretty crazy.
Yeah, it's really interesting how this has affected just so many different things.
Yeah. Again, I track consumer and cost of capital. I think the consumer psychology is changing. I do think we're going to become a renter nation. I think space is going to become important. Hence, apartments might be a problem. And then cost of capital. I keep going back. Is the pain on commercial going to be enough? And it won't happen this year, right? The Fed is open, but will it impact 2021, 2022? Where maybe we get used to 3% mortgage rates and all of a sudden they're 4.5%. That's where I just don't know. It's these dominoes. They all could tie together in a big bow in 2022 and be interesting to watch.
Yeah, it's a lot. And, the saving grace right now is fuel is very cheap. So as we open back up and we get back to work, what happens there? Because, that's a tax. So as soon as, fuel starts to rebound and rise, and starts digging into people's wallets. I mean, if you're one of those, $15 to $20 an hour workers, $1 a gallon makes a huge difference in your budget, So, and I mean, I remember when gas was, in my area hitting $4 when it's normally around 2.
Yeah.
I mean, people fundamentally changed the way they did things. I mean, people were buying cars because of that were more fuel efficient. It made more sense.
Yeah.
You were spending that much money on gas, and people were stopping eating out, stopping going to the movies. It made a big, impact. So those are the things you got to watch. And again, there's a lot of discussion about inflation. Is there going to be inflation? What is this going to look like? And again, the inflation you're going to see are going to be in assets. They're going to be in equities. They're going to be in, precious metals, so, oil, Bitcoin, all these things that the money is going to. Where the Fed and the government has really messed up and hasn't helped is the money is not reaching Main Street, small business Americans, right? If everybody in this country were made whole on the salary they lost, and the businesses were made whole on the revenues they lost, then there might be a different situation about, when it comes to inflation, things like that. But at the end of the day, it's just the banks, which, the stock market's important. That's a lot of people's retirement, right? So that is important. So you gotta keep that going, because if the stock market starts tanking and confidence is lost there, then that, that reverberates to the banking system. Then you get economic Armageddon, you get financial collapse, which is what they were facing in 2008 and 9. So they know now what they need to do. And the good news is we do have an unlimited ability. The question is, what does it look like in terms of, inflation down the road? And the way the Fed is putting money out there just isn't going to create inflation in, the retail sector and, just in the general areas that we roll in. But it is propping up Wall Street. It's going to keep that inflated until a time when that liquidity has to get sucked back out. And that's when you're going to see the big event there.
Yeah. Yeah. Lots of stuff going on. Any closing thoughts as we wrap up today's interview?
Yeah, so I think it's all good and encouraging. There's news on the front every day that we're closer and closer to a vaccine, closer and closer to treatments, more testing, all of these things that we need to get through this and to the other side. So there's great hope and optimism there. The key is, we'll see what's going on here in the next, few weeks in terms of what the results of opening up look like. And then the opportunities are going to be, like I said, in those areas of the residential housing market, the short-term rentals, and, there's going to be some distress there. Because the forbearance is only going to get people so far. That money is going to be due at some point. And for investment properties, if you had a balance sheet when you got that loan, the banks aren't going to be so forgiving and say, look, you said you had $100,000 when you bought this house. Where's it at?
Yeah.
And they're going to look at your expenses and say, I understand, you didn't lose your job. You didn't, you need to pay the mortgage. You had the money coming in, you had the reserves.
Yeah.
So, there's going to be a lot of stuff that they're not going to be, doing loan modifications for, and people are going to be forced to sell some of these properties. Hopefully all that'll come back and we won't see any of that, but there's going to be some of that. And then there's going to be the office and retail sector, and what do you do with those? So I'll tell you a niche, and I'll just give you a little niche here for a lot of people to keep an eye out for, where you can get the best deals right now and get the best upside potential is small hotels, like the little garden style 2-story hotels, walk up, exterior entry type product, and turning those into micro apartments. Depending on location, there's a huge niche for that, where you can turn them into studios, 1-bedrooms, by connecting units. That's where you'll be able to buy those things, serious distress, get them for pennies on the dollar, turn them around, renovate them, and convert them into micro apartments, and just make a huge margin on those. So that's a good little niche to keep your eyes out for.
I will be looking into that. Absolutely. Well, Greg, thank you very much for doing this, talking on Memorial Day. Again, always appreciate it. We'll talk to you next week.
Yeah. Thank you for everybody who's watching that, has served. And, if you've lost somebody serving, that's what today's all about. And our thoughts and prayers are with all of you. And we just thank everybody for their service and their sacrifice.
Yeah. Real quick, plug your YouTube channel. You're doing lots of great content there. Where should people go?
Oh yeah, Greg Dickerson. So just, the Greg Dickerson YouTube channel that's on there. And I'm all over, all the social media, Facebook, LinkedIn, Instagram, all that. So yeah.
Very, very cool. Thank you very much, buddy.
Yeah. Awesome.